Hello, this is Coach Mike from winningstockcoach.com. Going to get started with my weekly market overview video for the trading week ahead, the trading week beginning December 14th, 2015. Before we get into the charts, just a reminder, Fed policy decision comes out this week. A little speculation that interest rates might rise, so kind of be aware of that. But let's talk about the charts. Starting here with the DJI, that's the Dow Jones Industrial Average chart. Big old red candle last week. You know, before you look too much into that, I want you to look at just 4 weeks ago. Big old red candle. As a matter of fact, we actually failed to break below the low of that candle. So all thought aside, and what I mean by that is I think it'll go lower, but all thought aside, it hasn't failed that support. That support to me is really important in the sense of confirmation of what we've talked about in the video the last couple weeks, where the DJI was the first to really give us an actual bearish signal with the lower low made there on August 24th. After that lower low, subsequently, we've gotten a lower high that would really grant us some confirmation of that lower high, should we at least break below the low from November 9th, the week of November 9th. Now, you see my Fibonacci target up here for the high side. You know, you see these little dashed gray lines. This is the projection points for that. I'd say we hit pretty darn close to that target point and very accurately. And now we have two little target points to look for on that potential road down. I talked just a moment ago about needing to break this low from the week of November 9th, but then you see right here, 16,986.79, a fib target. Now, what I'm going to say with that is if we fail our support level here at the 17,245.24, I still think you need to take a longer term short trade, whether it be on the DIA tradable ETF for the Dow Jones Industrial Average or some Dow Jones stocks. But you need to watch really closely in that 17,000 range, because that could be an area where we just get a little bit of a subtle move down and do bounce off. And because of that, that would kind of be the danger zone of the trade. Now, one might say, well, why don't I just wait for that to fail? And normally I would say that. Normally I would be the one that says, hey, at this point, just wait for 17,000 to fail and then trade down to this 15,010. But this time, I think that there could be, especially for options traders, enough of a premium increase after failing this bottom from a few weeks ago that you would want to take that chance, even if that chance only got you a bounce around 17,000. I'm going to switch this over really quickly to the daily chart. And what I want you to see with the daily chart is a very, very reliable pattern. This double top right here, you see our double top beginning in November, beginning of December, and then this center area, which also correlates to that low that I talked about on the weekly chart. Now, after a double top, really, you should start by just expecting a double bottom. Hence why I said wait for that bottom to fail. Should it fail that bottom, it becomes known as a very, very reliable trade pattern, an M. M's are much like W's, but an M is bearish, a W is bullish. You see a W made on the chart here in the W break, getting you back up into that consolidation range we saw for most of the year. Now, one could argue very easily that technical patterns like an M or a W, you trade the breakout from or the retest of. So this W point right down here at 16,739, we'll just say 16,740, has not been retested. That's another little hiccup point. And if you look, and we'll talk about some other charts here in a moment, and when you look at those charts, you'll say, well, you know, those are the ones that I would sell at the W point. But this one, this Dow, is the one that I'd have reason to maybe let it bounce before stopping out of it. Don't just sell it right at the point like I'm going to tell you to maybe do with some others. But with this M pattern, if we break below the center of that on a daily close, the M has a very high probability of trading down to the prior low. That would be here at about 16,000. Now, if we go back over to our weekly chart and look again, that M pattern with a likelihood of trading down to the prior low. But the fact that this one index has already shown us the lower low and could very well be confirming the lower high should it fail this low from the week of November 9th. If we get that confirmation of the higher low, we have no reason not to expect a lower low again. And using the same points of projecting as I used to project this target area of 17,866.57, I would then be projecting 15,10.56, 15,010 and 56 cents. Now, as I look at that, we talked just a couple weeks ago, actually over the past 3 or 4 weeks, about starting a position and building that position. The building of that position or the rolling over to a later expiration in options, to me, comes at the time when we fail that 17,245 area. But not before that. Don't let yourself get caught assuming it will happen. I know in our chat room on Friday, a lot of people were assuming it would happen, but it didn't. So let's wait until it does and trade what is as opposed to the what if. Now we're going to move over to the SPX chart. That's the S&P 500. Unlike the Dow Jones Industrial Average, we actually got lower with this previous week's close than that week of November 9th. If you remember back through the last few weeks of our market overview video, when we started talking about the bullish and bearish signals that the different indices were making, the Dow was the only one that gave already a clear bearish signal with the lower low. The SPX hasn't. And as you can see, I've used trend lines to kind of pin it in a little bit of a wedge pattern. Over the past few weeks, I've talked about, for right now, remaining short term in your trading strategies for the S&P 500 so that you could take advantage of volatile moves that were leaving very little for longer term continuation. We also talked about, before really going to the long side again, because we had been up in this consolidation range and still consolidating, to allow it to break that high point before going long in any type of longer term trades on S&P 500 or the S&P 500 stocks that you might trade. Now, with this being said, and with the lower high, which seems to have confirmed itself, if we were going to get a little more downside, I believe it would be about to this 1967.53 area. Using the same projecting points as I did on the Dow, I come up with this 1850.67 target, which would then actually be a lower low after a lower high, but would actually be the first cycle of both a low and a high showing us bearishness. So I want you to keep that in mind when you understand the sentiment I personally intend to approach the markets with, which is really, I'm one that doesn't like to have a sentiment overall, which, a sentiment is a fancy word for a thought process. I have a plan, and my plan is based on reaction points, and all I do is cease the process of thought and react to those technical points. I'm going to switch over to the daily chart here on the SPX, and I want you to see a little bit of something very similar to that M pattern I discussed with the Dow. But because of some bullishness remaining here with the SPX, I think we still need to watch that W retest point at 1995. So as we start to watch this, I think we need to have a little bit of caution and still remain short term in our trading on the S&P 500, which is different than what I'm saying on the Dow, but only because of what it is showing us. Now, Friday in our chat room, we did some day trading, and on the SPY, which is the tradable ETF for the SPX, called within 1 penny of the bounce point that it had. And what's funny is that 1 penny it went below my target point. There was one transaction of only 39 shares. Think about that for a second. So, was I really off? But that point translated here on the SPX would have been right here. And as you see, we got real close to it before making a little bit of an up move. It's actually because of this that I would not be surprised to see an up move early in the week. I guess if you could think of it like this, with the Fed minutes coming out midweek, I'm not so sure that they want to damage the charts too much before those Fed minutes come out. I'm not going to sit here and say I think they'll raise rates or I think they won't raise rates. I think it's pretty obvious, even by Janet Yellen's statements, that they messed up. They should have raised rates this past summer, if not as early as March. But whether they should have is irrelevant in comparison to whether they have. So whether they do or do not, to be quite honest, I don't much care. I'm prepared to react in either direction. But because simply of the catalyst of the Fed minutes that will come out this upcoming week, I don't see them personally, the manipulation, the computer-controlled algorithms that dictate the trading in the markets. I don't think I'm wanting to screw things up too badly. Because if it is indeed no rate increase that's given, we could see the markets pop back up again. But if they do too much on the end of failing supports, they might not get the volume in any bullish run that they'd be looking for, which could hurt a bullish move. So personally, I actually think Friday was an accident. I think it was an accident that it dropped this much, and that we do need to possibly look for a bounce. Now, I'll also say this. I don't plan on going short in anything S&P related with just this wee little bit of room for that W retest. But if it fails that W retest, I do plan on shorting to this 1967.53 target for short-term trading, day trading, maybe a week out trading, possibly just trading into the Fed minutes and then selling and waiting to hear what they have to say on the policy moving forward. Again, I think the important thing is, though, with the S&P 500, is to be watching this wedge pattern for your longer term. I believe personally that this wedge pattern, which is declining on the tops and inclining still on the bottoms, will be the determining factor to long-term bullishness or bearishness. And should it follow the Dow, we could make the guess that it will be bearishness, but in all reality, I'm not one that really likes to guess. Moving over now to the Ndx the Nasdaq 100 chart. Now, this was the one chart that we talked about over the last few weeks where, August 24th it dropped, but it still made the higher low, and then actually made a higher high that I've spent the last few weeks kind of advising that even though it didn't quite hit my target, it was so close that I wouldn't trade anything new to the long side until we got a significant pullback, possibly into that W retest point that I've mentioned, we see that much like the Dow and unlike the S&P, it's failed this past week to break below the low set the week of November 9th. But should it continue downwards, I think 43, 47, 33, this target point, is exactly where, should we hit that and make a positive move from, that you would carry out exactly what I talked about in our video just a few weeks ago. The longs on NASDAQ 100 charts for the long term, using that as your support/stop area. Going to now switch this over to the daily chart, and we actually see that very similar double top pattern, which would have us then projecting for a support level of a double bottom, which means it's almost there. We would want to be watching that retest of a W breakout point here at 43.84. A positive move from there, I believe personally, would have to be one that gives you plenty of validation for making a bullish trade. But what's really appealing to me about the NASDAQ 100 as opposed to the S&P 500, remember the S&P 500's daily closed on Friday below this line from this November 13th low close. If the NASDAQ 100 were to simply have to play catch up to follow that, then we could actually be awaiting a trade on that. And if we see that failure, it's almost like we could get a little bit of a crystal ball effect where we could watch the SPX chart and plan for the Ndx to mimic it. And the trade I would look at making, honestly, would be on the QQQ, another tradable ETF for the NASDAQ 100. And I would simply look to trade that M failure down into the W retest on a short-term trade. Now, because that one is so appealing to me, I'm going to pull up the QQQ chart here. And we're going to talk exactly about the trade I think it would be wise to make. This trade would simply be if we failed 109.84. Now, I wouldn't do it necessarily if it just hit 109.83 real quick on an intraday chart. But this little wick down here with a low of 109.48, I would do it without a doubt should that price fail at any time. Now, I would probably recommend using like a 15-minute chart to watch that M point. And if you close a 15-minute candle below 109.84, I would look honestly at entering something as simple as this upcoming week's expiration, which happens to be the December monthly, December 18th expiration. And I think you would be just fine to take a 108 strike put for that. Now, at that time, you would honestly probably pay about $1.30, $1.40, depending on maybe a little bit of a premium increase. Should that fail happen, you might get up to as much as $1.60. But I would be comfortable even on that short term, should we get that failure and continuation, to be able to catch that retest point before Janet Yellen releases the updates on Fed policy. If you wanted to play that just a little bit more on the safe side, so you didn't have that time decay aspect kind of beating you up, to trade out just to the following week, but also that 108 strike, would give you less volatility on the gain side, but also would hold a little bit less risk or less loss should it work against you. Now, at the time that you enter that, as I mentioned, a 15-minute chart closed below 109.84. But any 15-minute candle that closed back above 109.84 would have to be your stop out for that trade. And I would target exactly dead on 107.13. And I would not even let myself think I would sell that short-term trade if I was fortunate enough to hit my target. What if it goes below the target? Well, I wouldn't care because I would sell it before it went below it. There would be other trades to make, especially for the Dow Jones Industrial Average at that time. So I would want to stick to where my probabilities are, still on what is a very, very bullish chart with the Nasdaq 100 and the QQQ correlating to it. Finally, now we're going to move over to the Russell 2000, the RUT, the small cap index, and look at a little bit of what we talked about over the past couple weeks. The first thing was we talked about should we get continuation above this little dashed blue line to look for long trades, for it to mimic what the Nasdaq 100 did or the SPX did, and at least move up into this range here for a long trade. The reason we wanted it to break that little dashed blue line was because of a potential of a technical pattern known as a head and shoulders. Now, you're going to see two lines down here that are red, this dash line and this solid line. The reason this dash line is here is because it was a swing low point that did fail down here. But if you look at the relevance of this price level, 1, 2, 3, 4, 5 bounces, we'd have to say, right off of that level, with only the one bounce down here. Now, I would also probably have to say that this point would now become your technical neckline should you make that head and shoulders. But it would be a neckline that I'd be willing to trade on an 1100 failure. And to be a little more precise, I'd want to go just a little bit below that to about 1080. Now you're going to say, well, then you're almost to that 1050. Yes, but I'm going to switch over to the daily chart and I'm going to show you why that value is what it is. Just like the other indices, we talked about that double top. We talked about the double bottom, which kind of held and it started to move up off of on Thursday. Then it gave it up on Friday. The M, that technical pattern we are seeing there, has a high probability of trading down to the prior low. That prior low being here at 1083.91. If it simply trades down to there and makes a positive move, the likely point of return is back to this failure point, 1146.55, for where it might retest. With the Fed policy decision coming up this week, I think any trade you'd make Russell 2000 related or maybe the IWM would need to be short-term and sold into that Fed policy decision. And that you would want to be watching these lines here on our weekly chart for one very, very simple reason. Should we fail that neckline, and even though I got this 987.72 projection here, that would be the most bearish pattern that we could observe as technical traders on the chart, a head and shoulders. Just like I said, that M pattern is likely to trade back to the prior low. The head and shoulders pattern is even more likely to trade back to a prior low point. For me personally, I would target for a longer term trade, should we get that neckline failure, a retest of what was actually at the time an inverted head and shoulders breakout point right here at 864.70. This makes this a very high priority chart to me, because even though you could say, well, you're well off the top, it'd be easy for one to also argue that we didn't confirm the top until we fail this neckline. And actually, at that point, the probability of producing a high profit trade is going to be severely increased. And this would be one that I would actually say you might want to trade 6 months out or so, the June 2016 monthly, or maybe even the September 2016, if you get that neckline failure, to trade down into that 865 area. This is Coach Mike from WinningStockCoach.com, wishing you the best of luck with your trading. Feel free to join us in our chat room as a member of the coaches roster. If you have any questions about that service or our assisted portfolio management service, feel free to email me, coach@winningstockcoach.com. Good luck and God bless.